Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from the WealthyHomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me on, Jim.
Ross, we have Mark from Kanata, which is near Ottawa, who asks, we're looking at houses and wondering how anyone buys a home using 30% of their after-tax income. That is now defining affordability. Should we be looking to commit more of each paycheck than the 30% after tax?
Yeah, I think this listener's a little bit confused, Jim. So, CMHC, we will use them for a reference. They say that you shouldn't spend more than 30% of your pre-tax income on housing, not after tax. And I don't know of a place in the world where people are only going to spend 30% of their after-tax income on housing. Maybe in some communist country somewhere where the government is not, you're not getting any money. Maybe that's it. But in Canada, I believe CMHC, they claim that it's 30% of your pre-tax income. Even that, though, Mark, in all fairness, it was an absurd comment from CMHC to make, because CMHC is insuring mortgages that are 36 to 39% of your pre-tax income to cover your housing costs. So here they are. They've been supporting Canadian families with mortgage default insurance for 30 years, where it was very, very common to see 32%, 34% of pre-tax income being used to fund the purchase of a home. Now, you have to understand, Mark, that when I'm talking about those numbers, generally I'm talking about, that's what we would call today's millennial. Millennials should be more than happy to spend, in all fairness, in excess of 50% of their pre-tax income on shelter. Now, I say that with a qualification. Depends what tax bracket you're in, depends what city you're living in, or what province you're living in, which impacts your federal tax, your provincial taxes, what municipality you're looking to live in, because that impacts your municipal taxes. And even, things like what are the hydro rates in your province or your town or your city? What are your wastewater charges? Do you pay for water coming into your house and also pay for the water going out of your house? Are you talking about a rural property where you don't have water costs, but you've got to keep a well going, a septic bed up to date? Those are all of the sort of things that really comes into a real affordability discussion. I do not think that if you're looking in Canada and if you're a first-time home buyer, you should be spending anything less than 40% of your pre-tax income on your first home. And you shouldn't be buying a first-time home unless your wage is set to increase over the next 5 years. And you should be someone who's employed in a job where your wage increase is going to exceed the rate of inflation. I say that because that is how most home buyers or most people who actually buy homes, that's what their buyer profile looks like. They are people who know that by the end of the first 5 years of their mortgage, first time their mortgage is generally up for renewal, they are going to be in a far better financial position than they are today, in terms of how much of their income they're going to spend on housing. That also means that they're going to be able to make life decisions 5 years in, because really start off buying a house and then thinking about starting a family is probably not the best procedure to be looking at. You certainly should probably be into your house 4 to 5 years before you think about growing your household. That's prudent. That's how generations of Canadians have, well, not generations, certainly for the last 30 years, that's what we've witnessed in home buyers. So you should really not be expecting to be any different than people buying in the 1990s or 1980s were experiencing. I think most of the problem you have, Mark, is that people talk about this on a cash flow perspective, okay? So this is really what it comes down to. Affordability is not cash flow. Affordability should never be defined by the amount of your income you're going to be spending as a homeowner. Now, if you want to be a tenant for the rest of your life, then the 30% of your pre-tax income going towards rental, that could be your choice. I know governments, Mark, want you to do that because governments are focused on cash flow. How much cash can they get to flow from your job into the tax coffers? That's what they're interested in. And I believe that's really why all of this you can now rent for the rest of your life discussion is coming to be in place, and why they are now starting to redefine affordability at this 30% pre-tax income level, and then they're referencing rental lifestyle. If you in 1990 you would have spent more than 30% of your pre-tax income on property taxes, mortgage interest, and renovations and maintenance on your home. More than 30%. If you buy a house today, you're not spending 30% of your income on mortgage interest, property taxes, and repairs and maintenance on your home. You're spending far less because you're paying down your principal so rapidly. For some reason, the government doesn't want to talk about that any longer, Mark, but that's something that you really should be looking at. So if you want to give a landlord 30% of your pre-tax income for the rest of your life, that's your choice. You are welcome to do it. Clearly, CMHC is trying to direct you into that because they have failed the Canadian public in terms of building out the housing stock. Your federal politicians have failed the public by refusing to build out the Canadian housing stock. So now they're looking to extract themselves from this situation by going ahead and saying, oh, there's nothing wrong with renting for the rest of your life. Look, about 20% of the Canadian population should probably be renters. Those renters should probably be in government-subsidized housing of some sort. It can be a small subsidy if your income level is just not quite enough to own a home, or it could be substantial if you're facing homelessness. And as Canadians, the other 80% of Canadians who should be homeowners, they will gladly support that through their income tax. But for governments now to try to extend that, go from 20% now maybe to 30% of the Canadian population renting. What's next? 35%. Oh, it's okay if we have a 65% home ownership rate and 35% rent for their entire lifetime. What's after that? 40%? It's okay if 40% of the Canadians rent for their entire lifetimes. Well, I think what they're really doing is they're structuring that so that they're going to collect more income tax from you. Because if you're not paying that extra that a homeowner pays towards paying down a mortgage, you're actually giving some of that 30% to a landlord to pay down their mortgage. Since landlords have held on to the properties for longer, they don't need you to pay down the principal as quickly as you would if you bought a home on your own. So when you hear these sort of discussions, Mark, you have to ask yourself, are they trying to get me to do something that is against my own best interest, against the best interest of my family? And this is the discussion with affordability. Affordability is not cash flow, okay? People have cash flow even in the rental side of the housing market stops at around when interest rates are about 6.3%. Cash flow no longer becomes important any longer. This cash flow discussion that you hear, oh, this condo is $300 cash flow negative. What a stupid investor this is. Oh, this is the risk to the housing market. These are simply people who who make those statements, who don't understand how you profit from rental housing. Cash flow in today's world is irrelevant, totally irrelevant. So when you hear these people talking, you have to understand they are irrelevant in their comments. They shouldn't be even talking about housing market. No more than someone who tells you that you shouldn't spend more than 30% of your pre-tax income on housing. If someone tells you you should only spend 30% of your pre-tax income on home ownership, then you have to ask, why did CMHC fund millions and millions of families over the last 40 years on a ratio that was substantially higher than that? Why was CMHC funding people paying massive amounts of mortgage interest each month years ago, and now they're saying, oh, you shouldn't pay yourself the equal amount to what homeowners were paying banks in the 1980s and 1990s. You need to sit down and do a budget, Mark. You need to sit down and do the same budget that you would have if you met a debt counselor. That debt counselor would go through your finances and show you how things work. Don't listen to CMHC. Don't listen to anyone else. Every single Canadian is unique. How they spend money is different. Their jobs are different. What they want out of life is different. What they want out of their family is different. What they want out of their house is different. You've got to see how different you are, Mark, and make decisions on your own.
We'll have more with Ross Kay right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, last week, real estate brokers in Vancouver released their August market update. Jane in Vancouver asks, we compared last year's MLS benchmark price against the latest for August, and we can see why Ross claims local brokers fabricate stats. When we do year-to-year comparisons of the identical benchmarks, our percentage change is different than what the Regional Real Estate Board of Vancouver announced.
There you go. So here, great job, Jane. Great job. So, Jane, you have announced something here on the show. You've asked a question that not a single realtor in the province of British Columbia or across Canada has mentioned. Not one. They're making all these comments and posting updated charts with benchmark prices without once mentioning what happened in May. So this is what happened, Jane. In May, they rebased the benchmark price. They adjusted it again. The absurdity of this thought process, that they would change the benchmark price, change last year's benchmark price, and then compare it this year. It is absolutely absurd that not a single newspaper in Canada has reported this. No one is talking about it. And everybody says, oh, well, it's only a few $1,000s, so the change is not that big. And we would say, hogwash. Everything organized real estate does, they do for a reason. The reason is to protect the earnings of their members. Members who have refused to publicly come out and say, hey, did you know that in May, they rebased the benchmark price again? Oh, and let's not pretend that it's a little amount, by the way, Jane, because there are some places in this country where the benchmark price dropped $200,000. There are other places where it increased $200,000. That's right. They went back and changed the benchmark price from last year by up to $200,000. So when they reported price change this year, the price change was smaller than it actually was by a massive amount, hundreds of thousands of dollars, or larger than what it really was. And you think it doesn't matter, but it really does. So if you go to you're in Vancouver, so pull theirs up pull up the chart from last year for Whistler detached homes, for the sake of the argument. And then look at the new price that they have released for the benchmark home for this year, this year's release for last year's price. You've got a $200,000 difference. I don't know what the actual number is. I know it's just like it's over $200,000. It's crazy. Well, why did that happen? Well, because you see, a group, Whistler, had a bunch of new homes sell in a different property class in the last 12 months. So they're using that against the public, because they're not only using it here in the benchmark price calculation for Vancouver, they're also going to use it for the average price in Vancouver, the average price in British Columbia, and then the average price in Canada. So you had about an extra 20 super ultra luxury class homes being purchased in Whistler in August that are going to skew the data not only for Whistler, but for Greater Vancouver, British Columbia, and Canada, just from those extra sales. So are they covering their tracks, or do they just think you, the consumer, is this foolish? They can tell you whatever they want to tell you, and you're going to believe them. Why didn't one single realtor in British Columbia come out since May and say, oh, by the way, the benchmark prices for last year have all been altered, so when we're comparing them year over year now, we're not really comparing them to what the numbers we had last year. We've updated those numbers, in some cases by hundreds of thousands of dollars, so the comparisons are no longer relevant. Didn't happen. This is the manipulation of the Canadian public. And this is what happens when organized real estate is going to cover its tracks. The only number that the public should ever look at is the average purchase price in a community. You're looking at that against the housing stock that's for sale, because then you get a little bit of an understanding as whether it's wealthy buyers buying this month or it's first-time buyers buying another month. If a whole bunch of first-time buyers, the share of sale to first-time buyers is low, then the average price will be higher. If the share of first-time buyers is high, the average price will be lower. If Vancouver's share of the British Columbia housing market is higher, then the average price in British Columbia will be higher. If the Greater Real Estate Board of Greater Vancouver's share of the B Korea's provincial housing numbers is lower, then the average price will be lower. Same goes for Fraser Valley, because those two markets impact the British Columbia average disproportionately in a crazy amount, because the trading rate in those two cities, in those two MLS systems, is higher. But that also means in the national numbers, they're skewed the exact same way. This is how a single house selling in Whistler causes the national average price of every single home in Canada to go up a couple dollars. Like, imagine the absurdity of this, folks. One extra ultra luxury class home sells in Whistler, and the value of every single Canadian home goes up. Now, were those foreign buyers? Have those extra sales that are taking place in Whistler, are they foreign buyers again? Are foreign buyers now buying in Whistler? Because since sales didn't increase everywhere else in British Columbia, the only huge price gain with the average purchase price changed happened in Whistler. Do you think that the odds are pretty high that would be foreign buyers? Wait a second. Didn't the Real Estate Board of Greater Vancouver pull this con on Vancouver home buyers for 20 or 30 years, where they included first-time buyers that were wealthy foreigners? In other words, the 4 or 5 houses that were needed to sell normally to have that expensive home sell didn't happen, disproportionately raising the average price. Did that just happen again in Whistler? Is David Eby going to check on that? Is our provincial government going to check on that? Is the federal government, the parties that are out in the election platform right now, promising you that they're going to stop foreign buyers? Have one of them mentioned this little change that happened out in Whistler? I mean, they have thousands of staff members. They have CMHC. They have Statistics Canada. They have all these people at their disposal. Was it really foreign buyers in Whistler in August that is going to raise the average price of a Canadian home when Korea reports on it early next week? I'll leave it for you guys to figure that one out on your own.
Ross, stockbrokers are having a hard time convincing people to invest in stocks and bonds versus real estate the last 10 years. Joel in Regina asks, Ross is warning about the pending house price correction and has been for a couple of years now. Does Ross see investing in real estate as a better alternative to investing in stocks? My financial advisor has never crossed into real estate investing other than REITs.
Well, of course they haven't, because they don't make any money by telling you to buy a real estate. So unless you have a financial advisor who gets paid a certain percentage share of your portfolio each year, you're never going to hear it. You're going to hear them selling you products that they sell. Look, there is no investment like real estate, and there is nothing that can return the zero risk returns that an investment in real estate is. Let me put this into context for you, Joel. If someone came to us with $300,000, okay, they have $300,000, and they said to us, what is the best return you can get for us? We would tell them, well, we can get you 12% a year, compound annual growth rate, over the next 15 years, and we will guarantee those returns. And the investor's mouth is going to drop open. What do you mean if we give you $300,000 that you can guarantee us 12% compound annual growth rate over the next 15 years? We would say, sure. And better still, here's our scam. Here's a little con we're going to run on you. So we're telling you right now, this is the little con that we're going to run on you. We're going to guarantee it, and what in exchange for that guarantee, the only thing we will be paid is whatever's on top of that 12% compound annual growth rate. So in other words, if it's 14% one year, we're going to get the 2%. If it's 15% the next year, we're going to get the 3%. If it's 16% one year, we're going to get the 4%. We're going to get all that extra money. We're going to as a matter of fact, we're going to leave it there so you can watch it, so your accountant can watch it, so your lawyer can watch it, and you can cry as you see how much more money we're going to be taking from your real estate investment. That's how awesome real estate as an investment class is. And the best thing about this is that this is ethical investing. So a real estate investor, an ethical real estate investor, does not care if their property increases in value. They do not care about squeezing the tenant in every way possible to get every single rent dollar out of them. They don't care about cash flow because they're buying their real estate investment just like you would a GIC. A GIC that will pay you 12% compound annual growth rate over 15 years. The only commitment you got to make is that you're going to leave the money there for 15 years. And this is why home ownership is such a great investment tool for people. Because when you have a smaller down payment, the actual return on your investment gets even more ridiculous. We use the 12% compound annual growth rate over 15 years because there's a zero chance of failure. 15 years you use because you don't have to worry about the housing correction and a return to the price that a property was at 15 years earlier. 15 years is going to do that. There's so much profit built into this model that even if that point isn't reached, you still get your 12%. Because it's not even based on 12%. It's actually based on 19% return. Your stockbroker's not going to tell you that. They're going to say buy Bitcoin. They're going to say invest in oil, invest in gold, invest in whatever. Well, you know something? Those are high-risk investments. In a country like Canada, housing is a zero-risk investment as long as you buy it from that perspective, as long as your perspective is that kind of a perspective. Okay, I'm not going to count on my real estate portfolio increasing in value 1 penny. I'm not going to count on it increasing in value 1 penny. I'm not even going to count on it maintaining an inflation-adjusted amount. Although we would tell you that you should do that, you still don't even need to do that. None of these things were possible in the 1990s. So when the original author of the RENX or whatever the heck it is network, Don Campbell, came out with his first real estate book. He was a real estate broker in RE/MAX, and he came out with this real estate book. Well, that real estate book was written from the context of the 1980s and the early 1990s, when interest rates were 10, 12, 14%. Why has the strategy not changed since then? Well, we give it to you simple. If we had an institutional investor who said to us, we have $300 million that we want to invest, and we want you to return us a 12% compound annual growth rate over the next 15 years. Can you do it? We would say in a blink. We would say not only that, bring in your team of accountants, bring in your team of lawyers, bring in all your friends and family, bring in whoever you want to bring in, and you can go over our numbers. Because our numbers are not based on the extra profit you make if a property increases in value. So that's why I believe, Joel, you don't hear other advisors talking to you about real estate. It's simply because they can't make any money from suggesting that you buy real estate. What I'm suggesting, Joel, is that they all start including real estate in their investment portfolios by charging you 1% or 0.5% a year, whatever they think they need to charge you on whatever your portfolio value is. It's time that we end the selling of financial instruments, in my opinion. That's my opinion. Yeah, they're going to tell you it's okay to buy REITs because they can make a commission off it. Your realtor's going to tell you to buy real estate because they can make a commission off it. Forget the commissions. How about being paid for the advice? So that's what my answer to you would be, Joel. Right now, as of today, I can walk out there and someone could invest $100,000 and you could give them a spreadsheet that shows them a 12% compound annual growth rate over 15 years of that investment based on zero change in the real estate portfolio's value. If the real estate portfolio's value increases, those are extra gains that you're going to make. There's no need for us to have to offer something like this as a guarantee because it's ridiculous. These are just sound, fundamental realities about real estate investing in this kind of an interest rate environment. It's going to change again once the interest rates rise above 6%. But, odds are, Joel, we could be 20, 30 years before we ever see that happen. Flip side, an economic devastation brought on by COVID could see the interest rates rise at a rate we haven't seen since the late 1970s, early 1980s. I think that's my biggest concern right now, Joel, is we are now seeing school starts back today in a lot of the cities across Canada. This is the true reopening, Joel. Everything else that you've seen up until now has not been real. From our perspective, we are only now going to see the housing market as it actually exists. We are only going to now see the number of restaurant patrons as it actually exists. The amount of money being spent on renovation is only now the way it actually exists. This is the official reopening. And I'll tell you this also, Joel. For the last 30 years, we have always saw back to school as the official reopening of an economy. So what a housing market teaches you is that really your year runs from the second week, kids are back in school, through to the following year, that second week. It doesn't run the way that everybody else looks at it. It's always based on a school year. And think about it, Joel. It only makes common sense. People really don't want to move their kid to a new school during the school year unless they have no other choice. The beautiful thing about having choice is it also creates behavior in home buyers, behavior in homeowners, behavior in home traders that you can always rely upon. We are now beginning next week. So right after career releases, for the sake of the argument, this will be one of those times where it really matters. You're going to see real housing data start to come out. So in terms of the financial advisor, Joel, you simply have someone who is untrained in housing markets, who can earn a commission from giving you real estate advice, steering you to something else that they can make money on. If they can show you that they can make you guaranteed a 12% compound annual growth rate over the next 15 years without the product they're selling you increasing a penny in value, well, you should go for it. And if not, then you should find out how that way of investing is an option for you. Then take it to your accountant or another accountant or maybe a debt counselor. I don't care. Take it to your lawyer. Take it to 50 people. If they prove us wrong, okay, don't do it. We don't have to worry. They're not going to prove us wrong. The numbers are in the numbers. Real estate is the best investment anyone can make in Canada. That said, you still should always be timing the market to maximize your gain. So if you want to get a 19% compound annual growth rate over the next 15 years, you got to make sure you time the market. That's it.
Ross, thank you so much for chatting with us.
And thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to our show at info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.